Good afternoon, everyone, or good morning, good evening, wherever you're watching all over the world. I am Simona Stankovska. I'm Head of Global PR for EXANTE, and this is, I believe, our fourth in our Future of Finance webinars. This afternoon, I am joined by Vian Sharif, Jonathan Ha, and Robert Rubinstein, and we're going to be discussing the hot topic that is ESG investment. I will pass you over to our panel in a minute, and they're all individually going to introduce themselves and tell you a bit more about what they do and what area kind of ESG they work in, or their view, why they're interested in ESG, and then we're going to move on to hopefully a debate about the topic, and to provide you with some kind of insights into kind of what's going on in the market, what's currently happening, and where maybe ESG is heading in the future, because there are a lot of different views on it, and hopefully we'll share some of those with you. So I will hand over now to Vian. Vian, welcome and thank you so much for joining us this afternoon. Please, could you tell us a bit more about yourself and the company that you work for, and what you're doing, because I know you're head of sustainability, aren't you? So why are you interested in ESG?
First off, Simona, thank you so much for having me as part of this very distinguished panel. I can't wait to hear the insights that Robert and Jonathan will be sharing with us. There's always something to learn in the space of ESG, and I guess that's where my path has led me. In a way, I didn't choose it. I happened to have the great privilege of working for an investment company for 12, 13 years, who was founded in an emerging market. So I ended up traveling to Africa. I ended up in Kenya. And about 10 years ago, I found myself on the plains of the most beautiful landscape I had ever seen, looking at the most beautiful, exquisite wildlife that I'd ever seen, and understanding that this was very much under pressure. And that catalyzed me into doing a PhD alongside work between Oxford University, the Conservation Science Department there, an incredible transdisciplinary professor who taught me that conservation is not just about conservation in the animals, it's about the systems that we put in place around it. And so between her insights and my professor at Imperial College, I completed the PhD alongside work and realized what an important system we have in our hands when we look at finance. And so increasingly, I tried not to go there, I tried not to do sustainable investing, but it came to me in the form of having this opportunity at FNZ, which is one of the world's largest investment platforms for facilitating wealth management and retail investor decision-making around how we support some of the largest financial institutions in the world to reach end investors. And so what I do at FNZ is start to bring together the tools we have around sustainability and help to put those in front of investors, whether they be retail clients, whether they be wealth managers, and increasingly whether they be asset managers, and help them understand how technology and the data that we have out there around sustainability can help them make more sustainable investment decisions.
Wonderful. Thank you so much. And apologies, you are Dr. Vian Sharif. I forgot you've done the PhD. So congratulations. And that sounds wonderful. So thank you so much. I will pass over to Jonathan now. Jonathan, welcome. Thank you once again for joining us. And I know you're in sunny California at the moment, having traveled back from Asia, but you are heading back to Asia in a few weeks. Can you tell us a bit more about what your company does, please?
Sure, I'd be happy to, and it's an honor to be here. Thank you, Simona, and thank you to the entire EXANTE team for having me, and also looking forward to learning quite a lot from both Robert and Vian. So a quick background on myself. I'm the founder and CEO of a software platform called Seneca ESG, and what we do is provide software to investment managers as well as corporates to help them better manage their ESG analytics and workflow automation. So what we like to say is that we are providing the tools for those entities after ESG data has already been obtained. And the reason that I got into ESG, it's pretty straightforward, I suppose. I was working in IT and also finance, fintech, as most people would call it, for quite some time, running a platform that is focused on data analytics. And I realized that, it's a big space. And one of my other passions, especially after having read a book called Let My People Go Surfing, by the CEO of Patagonia. His name is, I'm probably going to butcher his name here, but his name is Vian. Chenard, and it's this fascinating read about how he built this company from scratch, yet still holding true to his own personal principles of taking care of his employees, taking care of the environment, and treating all of his stakeholders and shareholders with respect and with transparency. And it really was the precursor to ESG. And when things started to come to a head for me was when I realized that there is actually a connective tissue, perhaps even more so than that, between a concept such as ESG and corporate behavior and corporate performance. And that's something that I'll speak on a little bit more today.
That's really interesting. Yeah, I'm really interested in the performance. Definitely, that's a really good aspect to look at. Thank you so much and welcome. Thanks again. And finally, last but not least, Robert. Welcome to the panel and thank you so much. I know you joined us last minute, so I really appreciate that. And can you tell us a bit more about what TBLI Group do and how you've kind of based your opinions on ESG?
Well, most people know TBLI because of our summit that we've held for the last 25 years, about 40 times in Europe, Asia, Latin America, North America. The goal was not to be a conference organizer. The mission was to change the financial system so it works for multiple stakeholders, not only the investor. So when we started, there was no PRI, the word ESG didn't exist. SRI was just starting at the time. There was no GIN, there was no CDP, there was no EDPA, there was no infrastructure. So we helped build that, and the mission was educating asset owners and managers about sustainable investment and showing them the 3 things they need to see before they'll embrace it, which is self-interest, opportunity, and money flows. And fortunately, there is no group more predictable than the financial sector. So behavioral change was never really a challenge. The challenge was access. The more money someone had, the more isolated they were. But convincing was actually very, very easy. And unfortunately, what we've seen over the years is that the choice was for the lowest common denominator, not, kind of Coke Light with watered down water. So were the investments that were originally intended to improve society and improve the environment and created this massive, supposedly $40 trillion going into ESG? No, it hasn't. It's done well for the industry. It's done well for the service providers, the research providers, the fund managers, but it hasn't addressed the issues that we were concerned about. So we've been shifting a lot more to regenerative investing. But our role was always education and advisory for those that were actually interested. If you were not interested, that's also fine.
Excellent. Oh, thank you very much. And it'll be interesting, to hear, what you guys are doing instead. Then, like you say, you've got a different viewpoint. So first of all, what I would like to say, just to begin with, is thank you to everyone who's watching. We will be taking questions right at the end, so please put your questions in the chat box. And then what I will do is we'll finish about 15 minutes before the end, and we will pose those questions to the panelists. So please do keep your questions coming. But what I'd like to start with, and I think let's start as we did at the beginning with Vian. ESG, obviously, it's a really hot topic at the moment, Vian. Everyone's everyone's talking about it, but what does it actually, I think, for the people that are watching, what does it actually mean? I mean, is it a kind of marketing term? Is it a funky kind of like trend that maybe, I think a lot of people talk about the millennial generation coming up with? I mean, what are we actually hoping to achieve with ESG? And how did it even come about? Because obviously 2020 seems to have been like the massive growth period, the emergence of ESG.
Simona, thank you. And I'd just actually like to touch on something that Robert brought up, because I think it's interesting in the context of this answer. What Robert said was that, first of all, not everyone is interested or needs to be interested. And second of all, even with all of the data that's proliferating, have we really made a change? Then he's more moving now towards regenerative finance. And I'm really interested in that, because I remember speaking to a dear and very well-respected advisor to the UN. And I said, look, developing this incredible new metric to measure impact, the impact of an investment on nature, because that hasn't been done yet. We have environmental data, we have societal data, and we have governance data. So this helps us understand how companies are managing themselves from these different perspectives, which is the answer to your question, I guess, as we stand. But he said, are you actually changing anything here? Or is it actually a system that you need to think about from a completely different perspective, i.e., how do we create regenerative models? So it's not, ESG is many things, and it will be many things to many people. But what fascinates me is exactly what Robert said, which is this is actually about changing what ESG is and how it operates.
Interesting. So Robert, I mean, should we bring you in here? Because obviously this is what you were saying. I mean, what needs to change? Because what is wrong at the moment?
I'll give you a very true story. I was invited by a very large family office in Singapore to visit them because they wanted to talk about ESG. And I was shocked when I opened the door, because there was this big sign that said coal trading, oil trading, and gas trading. But this is where the family had made their money in the past. But they wanted to move their money away from that and have money and their investment shifted toward things that would restore nature, improve society, create an environmental and social balance. And they said to me, Robert, we don't understand this. We're really passionate about the idea of ESG, but how is it that the most toxic companies score so well on the Dow Jones Sustainability Index? I look at BP and Shell, CO2 factories. We look at PepsiCo, diabetes. We look at Unilever, semi-toxic cosmetics, and processed food. And they score so well. And I had to explain to them, because the model used is not what they do. The model uses how they report. So those that report well, they'll score well on the index, but the index had nothing to do with anything related to environmental restoration or societal restoration. And unfortunately, the PRI and all of these aspirational statements, it's basically become a fitness club where everybody wants a membership card, but nobody goes on the exercise machine. So you can show, I'm part of this club, but I don't really do anything. If 40 trillion is going into ESG, as the industry is claiming, how could we have so much climate change destruction, biodiversity loss, water shortage, food shortage, health crisis, income inequality, pollution, threats, all of this, if all of this money is going in? Because one, it's not going in. A lot of the institutional investors, particularly pension funds, they're doing engagement, which is not changing anything. It's just chatting with the company, and hopefully there will be some behavioral change. If your issue about ESG is, I want to get my fees, I want to sell my data, I want to be part of the club, fine. Put up that sign and say it. But if you actually want to restore the environmental and social balance, you have to choose a completely different way of measuring the performance of companies. And I'm not really that convinced that listed companies that have stranded assets in old technology and the financial sector is not going to let them write that off, because that's why I'm personally more interested in non-listed companies that don't have that baggage. So I'm confident in the financial sector that when the asset owners, we focus more on the asset owners rather than the managers, when they see that they can have an environmental and social added value as well as a market rate return, they'll embrace that. And if they're not embracing it, they're not convinced. That's all. It's not, if you ask anybody, do you want a financial return or social environmental added value? Nobody will say to you, oh no, I want all my money to make life miserable for everybody. And I'm working at that 24 hours a day. The financial sector investors don't think like that. No one thinks like that. Not even maybe Donald Trump slightly, but most investors don't think. They just don't know that they can achieve both. The traditional model is you make money, dump it in toxic waste, you create a foundation, you give away 5%, which are subsidized by taxpayers. And we're saying, no, take 100%, create a risk-adjusted portfolio that is actually improving society and improving the environment. And if you want to give away 5%, then you're using 105% of your money, not 5%. And that resonates, but it's an educational issue. The reason why it's taken so long, even though we've been doing this 25 years, is the advisors and the wealth managers and the private banks, they've been blocking the door. They not only blocked the door, they put a tank, they sealed it over, they welded it shut. The group that refused to ever speak at our event, always, Mercer, Watson, Towers, they always refused to speak. The minute that they got a mandate, they were at the pig trough, very much encouraging ESG. So that's the historical background.
Yeah. But Jonathan, I think, you're of the viewpoint similar to kind of what Vian said at the beginning, that there are still challenges that persist around the kind of disclosure standards and the assessment frameworks. And maybe this is, I know Robert agrees with this, but I mean, can you elaborate a bit more on that in terms of where you see that going and where you think that needs to go?
Yeah, sure. Happy to speak on that. I think there's a lot of good points that Robert brought up just now. One of the things I do want to point out is that we still are very early on in the development of a common understanding to begin with, as well as common framework for disclosure and assessment. And I'll speak about the challenges there. And I don't think the right approach is necessarily to completely sidestep ESG. I mean, ESG, we can all be honest with ourselves. It's still a very amorphous term and concept. And, while there's certainly, gaps in its efficacy and its understanding and its, standardization, those are things that we should really take as a responsibility for ourselves to try to bridge. It's not that, hey, it's not perfect, let's just throw it out. It's a bit like throwing the baby out with the bathwater. If it is so early on in its development, why not be the change? Why not be part of the group or the individual or the organization that helps fill some of these gaps, bridge some of these gaps, right? And that's something that, we feel quite strongly about. But at the same time, I do echo a lot of the sentiment of what Robert said, which is, there's a lot of things that are still, amiss when it comes to how actually effective are these things that we're measuring for. Because when you do have these oil and gas companies and you have, electric car makers that all tout, themselves as being so good for the environment, yet we know that they are very resource intensive. We know that, they're still one of the biggest culprits when it comes to carbon, emissions. It's kind of like the goalposts constantly change, and the people that are moving the goalposts are the companies themselves, because they have very close ties with perhaps some of these ratings frameworks. And it's a good segue into perhaps some of the areas that I think remain as a challenge, which is, when we have a lack of not only disclosure standards, but also assessment and scoring standards, you have this very chaotic space where you can cherry pick what framework you're using. You can cherry pick what data you'd like to disclose. And ultimately, you can massage your score, because you have access to how these scores are actually being calculated, right? And there's many of these very well-known ratings agencies that a lot of these fund managers rely upon. And a lot of these ETFs, are indexed to, and so when these companies start gaming the system, as it were, it really defeats the purpose, right? But that's something that we feel is an area that can be changed. We certainly shouldn't give up on it. And with Seneca, the company that I run, we are trying to build software and tools that can help give more ownership and responsibility over how ESG data should be obtained, how should it be used, not to rely wholesale upon these ratings providers, because guess what, you can't trust them. If you take a look at how varied the ratings are, you can just know instantly that there's something wrong here. And when one ratings agency says that this company is a AAA, this other ratings agency says it's a C, and everything in between, it's like, well, okay, that doesn't seem right to me. But our approach is to start taking a look at the underlying data and start making your own decision as to what are the important elements. But obviously easier said than done.
Of course, yeah, because I guess there needs to be some kind of governance and consistency across the board when it comes, like you're saying, with these ratings agencies and how the metrics are measured. But is there something then? I mean, I don't know if maybe Vian, you want to answer this, but it's a long-term goal, right? This is going to take years. This is not an overnight success, and as ESG grows in prominence, hopefully these things will be cleared up as we go along.
First of all, I think we have to pay tribute to the hard work of all the individuals and companies who've got us to this point, because in my view, we have this opportunity now. It's been an extraordinary 18 months or a year. Regulators have stepped in and they've made decisions about disclosures, TCFD in the UK being one of them. And my question is, why does it have to take that much longer? Just a question. Secondly, I think we've come to a similar conclusion as Jonathan has. It's not about ratings, much as I'd love it to be. It just isn't. It's about so much more. And I think the piece around disclosures is going to be key, looking at the underlying data, but making sense of that is not a simple task. So that's probably how I'd look at where we are right now. Things have changed so much, so fast in the last year. Technology is running at a pace that is unprecedented. Data coverage, regulation. The question for me would be, are we now at this nexus where really we can change things very fast in this space?
Okay, but so then what is it a case of then individuals or managers doing, I guess, more in-depth, more of their own research? Is that what you're saying? Because a lot of the money at the moment seems to be going into ETFs, which obviously are tracking, and there may be products in there that investors don't even really understand, or companies that maybe that don't really there may be some very good ESG compliant companies in there, but equally there may not be. So is it a case of doing more kind of individual research, so picking an area that you particularly want to focus on and then sticking to that and doing your due diligence in that area?
I'll have a first answer here, but hand over to my distinguished panelists. So why is money flowing into ETFs? It's probably got something to do with the fees. So if you look, for example, we looked at some of the top most allocated funds from the perspective of wealth managers. So where were people allocating their clients' money? If you look at the top ESG or sustainable or responsible funds, most of those are actively managed, and they were only a third of the size of the largest index fund. And the fees of the active funds were probably 3 times higher. So I think people are starting to understand that there's a trade-off there. Do they want to pay that? I'm not sure. I think generally the trend is now very much towards index investing, which really points to the fact that what that's being based on is absolutely crucial. I probably open the floor to my panelists on the question of how do we go about this? Do we need to do a deep dive into one particular area and do that really well? Proprietary management, I'm not sure that's going to solve this, but open to their views.
I hear a lot of complaints. I remember the FT organized an event and everybody kept shouting over and over again, ESG data is not good enough. ESG data is not good enough, over and over and over. And I asked the question, how come nobody says that financial data is worse? If you look at the financial collapse that we've had multiple times, Enron, Parmalat, the Madoff, the China hustle, trillions wiped off the balance sheet. I haven't heard anybody from the financial sector, that financial data should be improved. But everybody's piling on to ESG, and they're never, even though I'm very critical of what it is, because I think we can go faster than the music and further. No one, it was really the only, there's never been a single company, maybe Enron, that went bankrupt because of bad ESG data, and they didn't go bankrupt because of that. And it was the analysts who predicted that BP was going to have problems because they spent 8% less on health and safety than their competitors. So, I think we have to address all of the myths. Impact doesn't perform. Impact investing has no good fund managers. Impact investing is a charity, all of these things. And you can say the same thing about hedge funds that always claim we're going to get 30% returns, or private equity funds that say we're always going to get 30% returns, and every fund manager beats the benchmark. So there's loads of myths out there. And I think even though I'm critical of ESG, I'm equally critical of financial fraud and financial data, which doesn't seem to bother anybody, because it's really coming down, as long as I'm making my fees, all is good. And it's the same thing with a strategy consultant. As long as I'm writing my hours, I don't know if you remember the Senate hearings with Goldman Sachs about when they were interviewing the 3 alpha males there who were telling in their emails, yeah, that was a really shitty product that we sold to our client, and we knew it was a shitty product. It was so shitty that we ensured that it would fail. So when Senator Levin asked Goldman Sachs, don't you have a problem here? You're selling a car that has no brakes and you're ensuring that the car will crash. And they said, we're market makers.
But you made an interesting point though, Jonathan. Sorry, thank you, Robert. We will come on to you to give your viewpoint on that. But based on what Robert's just said, a lot of skeptics about ESG will say that surely the financial industry is about making money. So really, and I know Vian, I think your quote said something about you can save for the future and still have a positive impact on the environment. But all the skeptics, how do you convince them that, because financial services, it is about making money. If you're investing, you want to make money. So where's the buy-in? Like how do you convince them that they can still do this and have a positive impact?
Yeah, that's a great question. If you had asked me that question 10 years ago, I would completely agree that the idea of making money and doing good are completely at odds with each other. It just seems like one is more of a PR exercise, and the other is more of a practical basically service delivery from an asset manager to their LPs, to their shareholder, to their investor base, right? And the two would never actually align, right? Fast forward to today, or perhaps just a couple of years ago, there is a growing body of research that shows on a mid to long term time horizon, there is a positive correlation between ESG progressiveness and transparency and financial performance. And it's not something we necessarily need to spend a whole lot of time arguing about right now. I think where the proof lies is the growing trend of hedge fund managers and mutual fund managers that are coming on board. And I think a lot of people might say that they're coming on board more as a PR exercise. It's greenwashing, right? They want to buffer their brand, their reputation. But if you see that Larry Fink is issuing a letter to his CEOs of his constituent companies within their portfolios, and this is coming from the largest asset manager in the world, greatest amount of shareholding voting power in the world, and has actually literally put his money where his mouth is by wielding that voting power in a way that allows him to vote out those directors that they found to be remiss when it comes to affecting change across the board when it comes to ESG. And they've been quite vocal. And they're not the only ones. It's just one of the ones that I think a lot of people can point to as a prime example of that. But you've got a lot of other mutual fund managers and hedge fund managers that were even earlier to this space than BlackRock was. And they've been, pushing the envelope. They haven't just been getting up on their stump and yelling at people saying, you should be ashamed of yourself and so on and so forth. They're literally actually using their voting power to vote out those directors on boards that they find to be less effective. When it comes to moving the needle when it comes to ESG, and that's been quite refreshing to see. When it comes to the financial aspect, one of the other things I also want to share, this touches upon my experience in China, a emerging market, as it were, but quite a large one at that. And that's one of the fascinating things about China is that they're often behind when it comes to adopting global best practices or trends or what have you, and oftentimes for good reason. Maybe these are things that are not necessarily helpful or appropriate for China's capital markets. But what's been great for me to see is that they've come to the same conclusion, and I'm painting a pretty broad brush here when I say they, but a lot of the local hedge funds and mutual fund managers in China have actually done their own research and have proven statistically that those companies that they've invested into in a long enough time horizon that have performed better, that are more transparent, across ESG metrics, have performed better. And my personal hypothesis as to why that is twofold. Number one, this is an emerging market. Emerging markets in general are very chaotic, right? And there's a lot of obfuscation. There's a lot of fraud, perhaps. There's very little visibility into how these companies actually are operating. It's just whatever they choose to disclose, right? And they say, hey, we're very profitable. Okay, I guess I have no choice but just to believe you. And if I don't, maybe the only recourse I have is just not to invest in you. But if I do take what you say as truth, then maybe I'm going to think that I'm going to be able to obtain higher than average risk-adjusted returns by investing in you. And what a lot of these managers have come to realize is that this is my second point, is that ESG for them is essentially just a much more robust risk management framework. Because if they have to their avail just these financial data, which Robert rightly pointed out is somewhat suspect to begin with, and they have very, very little additional data to go from. Any additional bit of data, hopefully, to some extent, truthful, that is useful in having a better understanding of their non-financial performance, and that's really what I start to think of ESG as nowadays. Not so much as a environmental, social governance pillar, sort of framework for understanding the company's approach to it. It's more of a very broad non-financial framework. It's basically a way to understand how does this company get managed? How is this company being managed and run from a non-financial perspective? And if they're not taking the care to understand from a long-term perspective the risks that are associated with environmental issues, the risk from social aspects, lawsuits that come from a lack of, understanding and programs and initiatives to protect employee rights and diversity and promote, good health and well-being of their employees, that can come back and bite them, and the governance thing is obviously a no-brainer. If they aren't being transparent enough, setting up enough checks and balances and understanding not just, the letter of the policy, but also the spirit of the policy, such that if policies change and become much more stringent, they're already there, they're already prepared. These are all aspects that, allow for ESG to be now considered a risk management framework, rather than, an environmentalist, sort of initiative, right? And this is music to hedge fund and mutual fund managers' ears, to portfolio managers' ears, because now they have more data to go from. Data that is inconsistent, data that has a lot of gaps. It's like Swiss cheese, when you look at the that's out there, data that is oftentimes inaccurate, but it's data nonetheless. And even in such a market as China, which I've been there for 11 years, is still very quickly moving. Certainly not an optimal market when it comes to information symmetry and fairness. But even there, and maybe because of that, ESG is actually playing a very big role, more and more so, I would say. But as I mentioned at the beginning of our discussion, there's still a long way to go, and I can share more on that, once we get to that topic.
Yeah, sure. No, that's really interesting, because so I guess in a way you're saying it's good for financial services as a whole, not just for people that are interested in the economical aspect and the of investing.
Yeah, I mean, I actually see them as one and the same. So you're not going to get Chinese hedge fund managers to get out of bed for anything except to make money. Okay, and if guys are saying, "Hey, give me more ESG data," okay, that means something. They really care about their reputation and their brand. They're all about yields. Okay, they're all about alpha. That's what makes money in China. Not brand, not reputation. In China, nobody knows who BlackRock is, to be honest. But if they found some research and they've actually proven it through some, pilot funds that they can actually make more money by integrating ESG data into their investment framework, then they'll do it. They could really care less about the political aspects or the branding aspects of it. If it makes more money, they'll do it. And when I saw that, I said, wow, that's amazing. This is something that I think we need more of, because then we can finally put to bed this whole argument about, okay, can we do good? Can we make money? What if they're in conflict? Okay, I think in some cases they are in conflict, especially in the short term, but in the long term, there is a growing body of evidence, not just from a research standpoint, but in practice, that shows that they are actually aligned. And that's quite refreshing to see.
Are you waiting for something?
Oh, the previous question, sorry, I was on mute. The previous question then, Jonathan, is, do you see funds, because obviously Vian was saying that the reason that a lot of the money flows into ETFs is because active managers are more expensive. Do you see that changing in the near future as well, then, as we progress?
No, I don't see that changing at all. I think, there's a common, sort of feeling that swinging between active versus passive management is a bit like a pendulum. The overall hypothesis is that, right now, well, the moment we are right now is that the pendulum has swung very far towards passive, which is index-based investing, which is ETFs investing, right? And when that happens, less and less, overhead, management fee is allocated towards research that could help uncover sources of alpha, where there are assets that are mispriced, perhaps the value is higher than its price and perhaps you should buy in, and then assets that are mispriced the other way, where there's lower value than what is actually suggested by the asset price in the marketplace. And when you get that in a very large scale, when everyone is focused on passive, you've got money managers that are just relying upon index providers and not doing their own research, so to speak, you get more and more asset mispricing, right? And that's when the pendulum starts swinging the other way, and active managers, come to the fore, and that becomes more in vogue because there's more alpha to be had, because there's so few analysts now that are actively covering these companies and uncovering these asset mispricings, and then the pendulum swings towards the active management side. Well, that's sort of the hypothesis that's been put out there for the last 100 years, and it's been true to some extent. But my personal feeling is that passive is here to stay because of advances in technology, because of the internet, the availability of information that's out there now. So you don't have as much information asymmetry where people can, or the smartest people or the people with the most research analysts have a huge advantage. I think because of technology, because of the internet, because of the commoditization of information, there is going to be a very, very large component of investing that is still going to be passive in general. But that's a very broad sort of comment there. When it comes to ESG, I think it actually further supports that trend, because ESG by nature is focused on metrics, is focused on measurement, is focused on the collection and provision of data and the auditing of such data. And when you have such massive amounts of data, hopefully we get to a point where it is robust enough. I think that would be further support for a passive strategy, where people can then, sort of build on the backs of giants and, rely upon the data that's being collected, by these big players, and hopefully it's a robust enough way that it's being collected in, and then build, passive-based strategies on top of that, right? But there's a lot of growing pains there, because the indices that we have available to us today, they're based upon the ratings agencies' own biased view of how these companies perform. And because it is so inherently biased, all the money, the billions and trillions that is flowing into so-called sustainable funds nowadays, I don't know if it actually has a real big impact. It's probably a little bit unfair to say that it's having zero impact, but probably not in the way that we would expect, just because there are many biases that are introduced when we rely too heavily on a single rating standard, right? And why should we, and it's really losing out on a lot of the nuances of how these markets differ from geographic market to geographic market, how sectors differ, that's how materiality comes into play, asset class, and even strategy, so you really cannot do a one size fits all when it comes to ESG assessment and scoring. And that's what these ratings agencies try to do, and unfortunately, it dumbs it down, lowest common denominator, as Robert mentioned, and it makes it so that, it makes the retail investment set, especially, and maybe to some extent the institutional investment set, believe that because they're putting money into an ESG fund, so to speak, that they're doing good.
Sorry to interrupt you, but are we actually, you touched upon it, are we actually making a difference? I mean, I don't know, I'll open it up to the panel. I mean, is there actually data that shows, I mean, have we improved on climate change? Are we finding ways? I know that Joe Biden in the US has got this kind of new clean energy policy. He's trying to get sustainable energy. Are we actually moving forward? Or, I mean, I know it's probably going to be slow in terms of its progression, but are we seeing change?
No, ESG is just a death march in the wrong direction, but slower. And people think that's progress. I think as long as products don't reflect their true cost, it's very hard for anyone, whether it's Vian or Jonathan or anyone, to really compare. You have a bicycle in the UK or in Europe, it's 25% VAT. You buy an airline ticket, there's no VAT, and there's no taxes on kerosene. So how are you possibly going to compare things when the true impact of the cost of the product and services is not there? When carbon is a real cost and the green taxonomy and products really reflect the true cost, Jonathan and Vian, they can do their job easily because it's easy to compare because all the externalities are in the price. They're not there yet. They're not there yet. And whether this new initiative started in December of net zero asset managers which is a reaction of PRI's failure. So now in 2030, we're going to reduce 50% CO2 emissions for our investments. And by 2050, it's going to be zero. Maybe not. Maybe, is anybody going to call you to say you missed your target? We'll see. At least it shows that people are not happy with the present system. But as long as the products don't reflect the true cost, it's not priced in, it will always be a challenge, always.
Okay, Vian and Jonathan, have you got anything to kind of counteract that? I mean,
yeah,
do you
I'd
think
reflect back certainly on what Robert said. I think things like the Dasgupta review in the UK, which is starting to recognize that there is a value, for example, which nature actually has a material value in our economic system. These are moves in the right direction, but it is 2021 and we're just starting to do that. So I think it's very interesting. And what came to mind when Robert was speaking was, I quite often think about the UN Sustainable Development Goals, and we need to achieve those by 2030. Well, that's not very far away. So I don't think, but all I will reflect back on, Simona, your question, are we getting there? Are things getting better? My understanding is that we're still quite far off being able to actually achieve the SDGs. So who is going to call on 1st of January 2030 and say, did you achieve no poverty? I mean, it's an interesting one.
But then that goes back then, I guess, to accountability, because if, let's say, somebody says, a company comes out and says, by 2025 we're going to achieve this, who then in 2025 goes, oh, you didn't achieve that? Like, who follows up on that? Like, is it a marketing ploy? Does it sound amazing for a company to come out and say that, and suddenly they get lots of investment because they look really great, and then in 2025 they don't achieve that target? What then happens? Who holds them accountable?
Yeah, so I think that's certainly a challenge. Where I think we are in terms of the overall ESG concept development and adoption by the market is similar to where I think financial accounting was, perhaps 80 or 100 years ago. And back then there was no single standard, for how you treat various complex financial matters, with tax payables or clawback methods, and whether you want to amortize over a certain period of time. All those things were just up in the air. You just did whatever you felt like was right, and then you kind of massaged the numbers and made yourself look as good as you could. And that's basically what's happening in ESG right now. People are massaging the numbers to make themselves look as good as they can. But where are we today when it comes to financial accounting? It's not perfect, but we do have GAAP and IFRS now to look to. We do have an entire audit industry. The what began as the big 8 or 9 and then dwindled down to 5, and now we've got 4 of them because of some bad stuff that happened. And some of them were mergers, but some of that bad stuff came to light, which is, if you can't trust the audit firms, who can you trust? And so now there is a bit of almost like a social contract, you could say, where you have this third party, an audit firm that is there to hopefully do some degree of diligence into whether the data that's being provided by the issuer is accurate and fair, and it may not be perfect, may not ever be perfect, but if you have that third party that's there to give you assurances, then that, is helpful by a large extent. And I think that's the direction that we're going, where hopefully we get to a point where there is a single or hopefully not, multiple, but if we can get to a point where there's just 1 or 2, similar to financial accounting, globally, not only for the disclosure side as to what these companies need to be disclosing on an annual basis, but also on an assessment side. And that's where a lot of these valuation models that came to light, from the iBankers over the last several decades, using this financial data to be able to create these pricing models. I think something similar will happen, something similar will evolve on the ESG side. And there's 2 things that we're missing. The first thing are those standards that I just mentioned. On the disclosure side, I'm going to give you an alphabet soup right now. We've got SASB, GRI, IIRC, TCFD, CDP, CDSB, and the list goes on, right? And then on the assessment side, you've got all those ratings agencies that are taking this hodgepodge of data, some of which follow GRI, some of which follow, SASB, some of which follow IIRC, and then trying to make some sort of, heads or tails, sense out of it. And then still being criticized by people like me for trying to do so. And then, when it comes to, investment flowing into this, they're basically flowing money into an imperfect system right now. And obviously it's not going to work perfectly, right? But my personal feeling is that, one of the major things that we are missing is having the standardization across the board for disclosure and assessment. The second thing that I think we're missing, and this speaks to, sort of the reasons, the motivations for why anybody does anything, and that's money. And the entire study of economics is about incentives, and incentives is basically money. So how do you get people to do things that you want them to do? Hopefully they're good things. You're a benevolent person or government leader, and how do you get them to do things? And that's basically giving them positive incentives. So what we're missing is once we get hopefully to a standard set of disclosure, but what we're missing are the government policies that give tax subsidies to those corporates that are doing better in ESG, whatever ESG means, right, at that point in time. The tax subsidies, tax breaks, perhaps even incentives for doing this, and that's the missing piece in the puzzle, because otherwise, purely based upon corporates, avoidance of being named and shamed, as well as corporate, greenwashing, we're stuck. Okay, we're only going to get to maybe 10% of the way. But if you've got some companies, and the whole oil and gas thing, I think that's a big, target for us to argue about. But you've got to look at it from a relative context standpoint, and you cannot compare an oil and gas company to an IT company because their carbon footprint is completely different. That's the entire idea of sector materiality. But what you can do is compare one oil and gas giant to another. Okay. Yeah. And if you compare these two and one is doing a lot more, relatively speaking, than the other, well, hey, guess what? We cannot live today in this world without petrol. I mean, it's in everything. It's in my clothing. It's in the products that I use. It's in this plastic bottle. It's in the. I mean, if everyone was just walking to work, maybe it'd be a different story. But a lot of us use cars. Even if you use public transport, that is dependent highly on petrol. Okay, and so now it's not a game of how do we get rid of petrol. It's more of a game of how do we measure from a relative standpoint how each of these companies are doing. Comparatively within the industry that they're in, materiality, right? And which ones are doing better than others, and penalizing the ones that aren't, doing anything to improve, and rewarding those that are. And that, from a very large scale standpoint, and long-term horizon, is the way to go.
Sure. No, that makes sense. And I mean, I think that moves us really well into the questions, because I'm just a bit conscious of time. Thank you, Jonathan, in terms of our Q&A, because we've had quite a few questions come in. And actually, I think you've really touched upon a lot of these things in this answer, because Jason Keogh said, how do we change people's mindsets? And like you said, you give them, reasons, you give them incentives to want to, to encourage them this is the future. They're building this for their children, for their grandchildren. This is helping everything, the planet, animals, whether it's the kind of the religious views, whatever, it's everyone is working together to, and a bit like you said at the beginning, that it's if one person, if we all take our own responsibility to be that one person that does some good and has looks at our impact, then together it will grow.
Absolutely.
It's never really been that hard to convince people. I mean, I was actually quite surprised. It's rather easy. You just have to show them, the self-interest, opportunity, and money flows, and the predictability of the financial sector is beyond belief. So it's not hard to convince them, but you do the mistake that many people were making. They were shouting loudly in Mandarin to someone who spoke German. So they were
Yeah.
speaking a completely different language and thinking, I'm going to convince them just by shouting louder. You're not.
Mm-hmm.
You won't get through to them. You know, if
Yeah.
somebody achieves the moral imperative in the way they manage money, but they miss their target, they're fired. So if you do
Yeah,
not understand that, then you
that's
will
true.
never get through to them. You must align the interests of the person you're trying to convince and
Yeah.
show them how they can achieve those interests, and also show them the risk and the opportunity related to regenerative or sustainable investment or even ESG. So
Sure.
convincing
Sure.
them is very easy, but it's farming, and the financial
Mm,
sector are hunters. So it's
yeah.
hard teaching farming to hunters.
No, of course, but you know, that's why again, it's everyone's responsibility to understand what they're doing and you know what they're investing in, because it's not just about being convinced because you know the dollar signs are there. Yeah, you're going to make a return. The next question, I don't know who this is from, I'm afraid. So thank you for your question, but it's they say SRI, ESG, CSR. Triple bottom line, even the approach that companies take in sustainability, it's all done from a context of how to get the natural world to fit our mind-made concept of business and economics. How do we flip this to ground our belief system in natural laws and physical systems rather than systems we made up? And how do we transform collective thinking to have our economics fit in the way the natural world actually works? Isn't this what is really needed to achieve the end result of sustainability?
Yeah, if products reflect their true costs and you have everything included there, the rest will fall into place. But they don't. They don't. You know, people don't pay taxes. The corporate sector spends a lot of money in lobbying to keep the system as it is. That's not even looked at in the ESG space. So as long as the system is rigged this way, don't expect too much change.
Okay, well, Jonathan and Vian, anything you'd like to add there?
Well, if I may, I'd just like to point back to the Dasgupta review and work like it. I think it's interesting how that narrative is changing, and I fully agree that there's a this is points also to the discussion around regenerative markets. So how do we price these things in? And I think it's we're on a really interesting path, and it's better that we're here than not having considered these things. And this is time to continue this trajectory. So
Hopefully.
Wonderful. Jonathan, is there anything you'd like to add?
Yeah. So the idea of connecting the natural world, with how people are living their lives. I think that's a very valid point. But I do also think that people are governed by laws that other people create, and we have a social contract with each other, and it's not something that we can avoid. But if there's a way that we can better reflect what are the objectives for us to achieve in the natural world, to preserve biodiversity, to reduce carbon emissions, to make for a longer term sustainable livelihood for our children and grandchildren, that should be built into the laws that people create. They're not natural laws, obviously, but you cannot sidestep that because there's, that's the way that people operate, right? And that's how people have operated for millennia. So we need to align the two, and that alignment is not going to be easy to come by, but it's necessary, and it's part of the path that ESG needs to take.
Sure. And Jonathan, thank you very much for that. Whilst we're speaking to you, there was a question directly for you. I think it's Peter, sorry if I pronounce this wrong, but Peter Sumac says, do you prefer China over other emerging markets?
Preference is a pretty subjective term, I suppose. But in terms of investing, I'm not here to share necessarily my own personal investment opinions, but I do think China is a bellwether for all of APAC just because of its size and how quickly it's moving. And so if you want to understand APAC, you want to understand what one of the largest emerging markets is going to be doing and what it's going to become. Look to China, because it is such a large component of that, and they are moving so quickly.
Simona, I must jump. So I have a hard end of now. So I'm
Sure.
very sorry, but I must leave.
No. Thank you so much. We'll wrap up soon, but thank you, Robert. Really appreciate.
Thank you very much, Jonathan
Thank you.
and Vian. Very nice meeting you, and let's please stay in touch.
Thank you.
Sorry.
Sorry.
I also have to head.
Sure. Shall we? Okay. So let's wrap up. Sorry. What we'll do is I will put all these questions into an email if that's okay. If we can answer them afterwards, if that's okay. But thank you so much for being part of the panel. I mean, can we quickly wrap it up with what is the future? Is ESG is it the future? Is this going to continue to grow?
You go first, Jonathan.
Yes, ESG is the future, and it will continue to grow. At the risk of being a bit flippant here, I do think it's going to be as important as financial accounting and as natural to think about and consider as part of your business as the internet. There is no company now on the face of the earth that doesn't consider the internet as a key component of their operations. And I think ESG is similar in that very broad context that 10, 20 years from now, it's just something that is naturally considered when managing a company and operating a company.
Thank you so much, Jonathan. I think that I can definitely see that. Yeah, I take it you agree with that.
I agree with it. And I think what's really interesting is one of the things we haven't discussed, which is we've talked about how ESG applies to investments of the asset owners. We've talked about how it applies to the asset managers. But there is a whole cohort of the market which makes up pretty much half of the investable universe, or the investments that are invested currently, and that is the retail investor. So what we're going to start to see is retail investors starting to understand the environmental and societal impact of their investments, and much of these investments come from medium income households, the likes of us. Is that going to revolutionize things? Is that going to accelerate things? Maybe. So I'm really excited to see what happens.
Sounds wonderful. Yeah, I mean, definitely. I guess retail investors make up a large proportion of that marketplace. And it'll be exciting to see where this goes. And Vian, you touched upon it. There's so much more to talk about when it comes to ESG. And I think we will try and hold more of these webinars. Thank you to everyone for your questions. We will try and answer them all via email. So sorry we couldn't. But thank you, Jonathan. So Jonathan Ha, founder and CEO of Seneca ESG, and Dr. Vian Sharif, head of sustainability at FNZ. Thank you so much. And also thank you to Robert Rubinstein, who's chairman and founding partner of TBLI Group. Really appreciate your time. And thank you to everyone for watching. I look forward to hopefully chatting again soon. Thank you so much. Have a great day.